All right, welcome back, everybody. I'm sorry it's not Saturday, March 11th anymore at 9 p.m., but I'll tell you what, I did get this video up, so stick with me. Check it out. This is value to all the traders and investors out there. If you know what I'm talking about, you do. If you don't, I'm going to try to walk you through it as quick as possible. Check it out. This is one of my strategies. My favorite one right now is just easy, it's simple. It's like making rice. So here we go. You go to tradingview.com, right? And check it out. This is like Martha Stewart. So I already got the receipts ready. This is what the website looks like. From here, you go ahead and enter in this box. You enter your little stock. I like to use S&P 500 for this strategy. You go to it'll show up down here. You'll click it. It's that one. You go back over, it'll open up a chart. It'll look like this. What you want to do, come up here. You want to compare it to an indicator called the put-call ratio for equities and indices. That one right there. And it's going to take a while to load on my computer. So we're going to act real simple, all right? And I forgot to cook this one, but stick with me. So all I do is I look at what the ratio says it was for the current day compared to the previous day. All right? So let's do a little zoomy zoom. Here it is, right? I look at it, the change from the previous day to this day, and look, it was a positive change. I mean, just look at it visually. Don't ignore this number. So it went up, and this is a ratio. It's a ratio of the puts to the calls. Puts typically in this market means that the market's going down when there's more puts than calls, and vice versa. When there's more calls than puts, that means it's going up. And how do we figure that? Well, it's a ratio, which means it's puts over calls. And so if it's greater than one, typically you have more puts than calls. But I'm not even doing that. I'm making it even more simpler for you. I just look to see, were there more puts added to this aggregate yesterday, like from yesterday to today, then there were calls added from yesterday to today. And this line shows it by merely saying, okay, the value here was less than what it is on this day. And we're looking at Friday data, Friday, March 10th, right? So it went up, which means, hey, I guess people think the market's going to crash or something, or they think it's going to go down. And so what happens is on Monday, what we're going to hope for is that it goes down. And the way that I trade this, I just look at, okay, right before market closes, I look at the value. If it's going up, I say I open a put for probably about 2 days out. If you don't know options, hit me up. We'll talk. And like, I'll give you an example for what I do when I believe the market's going to go up. So when this value goes down, which would be, say, from the 6th to the 7th, we saw the ratio go down right in this little value here. Sorry, it's blocked by this little plus symbol. And so we go, all right, from the close here, all right, so it kind of went up, over the 2 days, and I opened a 2-day contract. So if you have the stomach, you hold it long enough, you're gonna make some money. But typically, I'm settled with 10 to 30%, and then I also add some additional intuitive things like were there interest rate decisions on this day? What did the Federal Reserve have to say? What's the general global economic outlook looking like? And I add that to this little strategy, and boom, like that, you're making as much as 30, 90% every day using options, high risk options, but never risk more than you're willing to lose. So I'm actually still developing the strategy as well, and I'm trying to figure out which time frames it works on. Particularly, I showed you today because that's where I started looking. But I actually really look at the weekly time frame for all my trades, which tends to work. So I will buy at the last day on the last hour of the previous week, and hope that it creates enough volatility and price change in the current moment to generate the growth that I'm looking for. I also then look for an opportunity to re-enter a trade if I don't get the growth and I actually occur a loss. And what that looks like is I'll literally do what's called a martingale trading strategy, and I'll double down on the original position. And as long as it reaches the original opening price, then I'll make a little cash. And right here, you're seeing what it looks like on Robinhood to do part of that process. All right, So on the next video, we're gonna see you out on the streets. Come